Okay, everyone, it's time for another weekly wrap, and I'm going to try and do this weekly wrap a bit off the cuff again. Normally, I prepare all my comments ahead of time so things go fairly smoothly. Also, so I don't do videos over and over. Sometimes if I don't prepare adequately, I'll wind up doing a video 3 or 4 or 5 times sometimes. But I think this time I'm just going to go ahead and push through this by way of a normal analysis. Again, I want to show you the type of analysis that I go through and just really how little time this stuff takes once you get the basic skills down. And hopefully by now, if you've been listening to these weekly wraps, you've been watching the daily videos that I send out, you see that I am a big fan of planning. I'm a big fan of picking the points where you are going to enter the market rather than hoping and wishing and sitting around and waiting for the market to do something that may or may not come in the future. It's not to say that I don't like different divergence systems and different trading systems, but I really think that just adding a little bit of planning will really take a lot of the stress out of your life. Because, truly, let's think about it. Do you really know when a MACD is going to diverge or when a MACD is going to cross? It could happen, or even a moving average like you see on the screen. Do you really know that the moving average is going to cross at this exact price? If you can't see any of this trading over here, you have no idea what the market's going to do there. So as you see the market trading into it, look at how fast these things cross here. Not very fast at all. Look at how much trading went by and how big of a move it took in the marketplace before finally the moving averages crossed. So it's not necessarily true that I hate different trading systems. I just think that you have to have some sort of planning to go into it. And besides, I don't know personally any professional hedge fund or bank type of traders that really use a lot of this nonsense that's out there on the marketplace. They use common sense approach to the marketplace. They know how the market works, and they simply have a plan. Speaking of that, let's just get right to it here. We're looking at the British pound. We're taking a trip down memory lane again. Here's 1978. And you can see that the market had moved up fairly quickly, and once it broke through, especially this level here, it had a bit of difficulty getting through it. But once it did, it gave it the old kiss goodbye right here, and then took off for the all-time high, which is right here, 2.4490. This obviously was a very bearish time for the U.S. dollar, and if you remember coming into 1980, there were a lot of reasons why. High interest rates were coming into effect. There were a lot of monetary problems. The U.S. was just coming off of Nixon devaluing the dollar, in essence, by taking it off of the gold standard. And, some people really miss that. You've got to start understanding the perspective of a lot of this stuff. When Nixon took the U.S. dollar off of the gold standard, you've got to think about what did that actually do. And when you consider it, what it actually did was it took the U.S. and devalued the currency. In other words, you had a currency that was backed by a real commodity, meaning gold, and then it's backed by nothing. The so-called full faith and credit of the United States government. Well, governments can go out of business. We've seen that happen over and over throughout history. So, credit of a government is only as good as the people running it. And without getting too political, I don't have too much confidence in the people that are running it at this point, which means you may see that scenario playing out in the U.S. dollar. If people don't have confidence in the U.S. dollar, you're going to see other currencies move against it